Disclaimer.
If you checked the price of physical silver in Tokyo this morning, then pulled up the COMEX futures quote in New York, you witnessed something that should not exist in a functioning market. You saw a $55 spread between the same metal trading in two different places. You saw proof that the paper price is a fiction. You saw evidence of a supply crisis that was engineered on January 1st when China flipped the switch on export restrictions. And the financial media isn't going to explain what you're actually watching unfold. This isn't some temporary glitch that corrects itself by tomorrow. This is the largest divergence between paper and physical prices in precious metals history, according to the London Bullion Market Association. When you see a spread this massive, it means one of two things. Either the paper market is lying about the real value, or the physical market is in full-blown panic mode where buyers will pay any price to secure metal. In this case, it's both. The paper contracts are fiction backed by metal that doesn't exist in deliverable form, and industrial users who need silver to keep factories running are scrambling to lock in supply before it disappears completely. You might be wondering how we got here. Let me take you back through what happened last year, because 2025 was the year silver exploded in ways that caught almost everyone off guard. The metal surged 148%, marking its best performance since 1979 when inflation was ravaging the American economy. Silver touched a record $84 per ounce in December, shattering the previous all-time high that had stood for over 4 decades. Financial analysts on Wall Street were scrambling to explain why this industrial metal was outperforming gold, stocks, and even Bitcoin. Then something interesting happened right at the peak. The Chicago Mercantile Exchange suddenly raised margin requirements on silver futures contracts, forcing traders to put up more cash to maintain their positions. Within days, the technical selling triggered a pullback that had nothing to do with supply and demand fundamentals. The price dropped, the financial media called it a bubble popping, and mainstream investors moved on to the next story. But here's what they missed completely. While the paper price was falling, physical delivery demand hit historic highs that no one in the financial press wanted to talk about. The COMEX market went into backwardation, a rare condition where immediate delivery costs more than future delivery. In normal markets, you pay more for something delivered later because of storage and financing costs. Backwardation signals one thing. People want the physical metal right now, and they're willing to pay a premium to get it immediately rather than wait. That's not speculation. That's panic buying from industrial users who need silver to keep their factories running. Pop quiz. What do semiconductors, solar panels, and electric vehicles all have in common? They all require silver for manufacturing, and they all depend on supply chains that just got severed by China's new export policy. On January 1st, China implemented restrictions affecting 60 to 70% of global refined silver supply, according to data from the World Gold Council. Overnight, the world's largest silver refining hub transformed from an open market into a controlled commodity where only 44 approved exporters can ship metal outside Chinese borders. But it gets better. Those approved exporters now must prove they can handle at least 80 tons of silver annually, effectively shutting out smaller operations and consolidating control with state-connected enterprises. If you're a solar panel manufacturer in Germany or a semiconductor fab in Arizona, your silver supply just became subject to approval from Beijing. Think about what that means for our supply chains, our manufacturing base, and our national security. Let me put this in perspective with real numbers from the Silver Institute's latest supply and demand report. Global silver demand in 2025 reached 1.24 billion ounces. Total mine supply and recycling produced only 1.01 billion ounces. That's a structural deficit of over 200 million ounces, and it's the 5th consecutive year where we consumed more silver than we produced. The gap has to be filled from existing stockpiles, and those stockpiles are vanishing at an alarming rate. Check your retirement portfolio for a second. If you own silver through exchange-traded funds like SLV or SIVR, you're holding paper claims on metal stored in bank vaults. Here's the uncomfortable truth that your financial advisor probably hasn't mentioned. COMEX registered inventories, the silver actually available for delivery against futures contracts, have dropped 70% since 2020, according to CME Group data. We're talking about real metal leaving the vaults, while the number of paper claims against that metal keeps growing. At some point, that math doesn't work anymore. Want to see how fast this can spiral? Last October, India's government placed an order for 1,000 tons of physical silver through the London market. The entire London silver market seized up. Lease rates, the cost to borrow silver for short-term delivery, exploded from 0.25% to 200% practically overnight. Banks and refineries were scrambling to find metal they thought existed in their inventory systems, but couldn't actually locate in physical form. That was just one large order from one country. Now multiply that scenario across every industrial user worldwide, trying to secure supply before China's restrictions take full effect. The timing couldn't be worse for anyone holding paper silver contracts. Between January 8th and January 14th, the Bloomberg Commodity Index is rebalancing its silver holdings. Technical analysts estimate this will force sales of over $5 billion in silver futures, as index funds automatically adjust their positions. That is enormous selling pressure hitting the market at exactly the moment when physical supply is disappearing and industrial buyers are desperate. If you understand what's really happening, this creates a once-in-a-generation opportunity. If you don't, you're about to watch your paper investments get crushed while physical metal holders profit from the chaos. Elon Musk saw the writing on the wall and posted publicly that China's silver restrictions are not good for global manufacturing. Coming from someone building electric vehicles, solar panels, and satellites that all require silver, that's not casual commentary. That's a warning from an industrial insider who depends on commodity supply chains and just watched his metal costs potentially double while availability became uncertain. When the world's most prominent manufacturer starts sounding alarms about supply, you should probably pay attention. Here's what most people don't realize yet. China isn't just limiting exports randomly. They're following the exact same playbook they used with rare earth elements over the past decade. First, dominate global refining and processing. Second, create dependence where other countries have no alternative suppliers. Third, restrict exports to prioritize domestic industries, while foreign competitors scramble for scraps at premium prices. It worked perfectly with rare earths, giving China leverage over everything from defense systems to smartphones. Now they're doing it with silver, and our country hasn't prepared any meaningful response. The implications extend far beyond metal prices. Our renewable energy transition depends on silver for solar panels. Our electric vehicle revolution requires silver for batteries and electronics. Our artificial intelligence boom needs silver for the massive data centers powering machine learning. China just put their hand on the valve controlling all three of those strategic industries, and they can turn it however they want. This isn't about investment returns anymore. This is about who controls the critical materials that will define the 21st century economy. You're watching the early stages of a supply crisis that will force major changes in how we think about commodity markets, strategic reserves, and national security. The question isn't whether silver prices will rise from here. The question is whether you'll be holding the right kind of silver when the two-tier market fully separates into paper claims trading at one price and physical metal commanding a massive premium. What happens next will determine who profits from this crisis and who gets left holding worthless contracts. Let's talk about the numbers that Wall Street doesn't want you to examine too closely, because once you see them, you can't unsee the crisis building beneath the surface. This is the fifth consecutive year where global silver demand exceeded supply, and the deficit keeps growing wider. The Silver Institute's latest data shows 2025 demand hit 1.24 billion ounces, while total production from mines and recycling delivered only 1.01 billion ounces. That's a 230 million ounce shortfall that had to come from somewhere. Where did it come from? Existing stockpiles that are now running dangerously low? COMEX registered inventories, the actual silver sitting in warehouses available for delivery against futures contracts, have collapsed 70% since 2020, according to CME Group's own warehouse reports. We're not talking about a small drawdown here. We're talking about the primary delivery mechanism for the North American silver market losing most of its physical backing, while the number of paper contracts outstanding continues to climb. That's a Ponzi scheme in slow motion, and it only works until someone demands delivery. Someone did demand delivery, and the whole system nearly broke. Last October, India's government placed an order for 1,000 tons of physical silver through the London market. Not futures contracts, not options, not ETF shares, physical metal that needed to be located, allocated, and shipped. Within hours, the London silver market froze up like an engine that just ran out of oil. Lease rates, which measure the cost to borrow silver for immediate delivery, went from 0.25% to 200% in a single trading session, according to data from the London Bullion Market Association. Think about what that means in practical terms. Banks and bullion dealers who thought they had silver in their inventory systems suddenly couldn't find the actual bars when someone wanted to take possession. They were offering to pay 200% annual interest just to borrow metal for a few weeks to satisfy delivery obligations. That's not normal market stress. That's a scramble to cover positions that should never have been opened in the first place. Positions backed by metal that existed on spreadsheets but not in physical form. And that was triggered by just one order from one country, before China, as export restrictions even took effect. Now multiply that scenario across every semiconductor manufacturer, every solar panel producer, every electric vehicle factory that needs silver to maintain production. China's new export rules require that only 44 approved companies can ship refined silver outside their borders, and each one must prove they can handle at least 80 tons annually. But here's the detail that should concern you. Most of these approved exporters need $30 million credit lines and documented relationships with state-owned enterprises. This isn't a free market regulatory framework. This is nationalization disguised as licensing requirements. You know who saw this coming and tried to warn people? Elon Musk posted publicly that China's silver restrictions are not good for global manufacturing. When someone building electric vehicles, solar infrastructure, and satellite networks tells you a commodity restriction is problematic, you should understand he's speaking from direct experience watching his input costs spike while his suppliers tell him delivery timelines just became uncertain. Musk doesn't post about commodity markets casually. He posts when supply chain disruptions threaten his ability to execute contracts and meet production targets. China is running the exact same playbook they perfected with rare earth elements over the past 15 years. First, they built dominant refining capacity by accepting environmental costs that Western countries wouldn't tolerate and offering prices that drove competitors out of business. Second, they created dependency where alternative suppliers either didn't exist or couldn't scale fast enough to matter. Third, once control was established, they implemented export restrictions that prioritized domestic industries while foreign manufacturers paid premium prices for whatever supply China decided to release. It worked flawlessly with rare earths, giving Beijing leverage over everything from guided missiles to smartphones. Now they're executing the same strategy with silver, and we're just beginning to feel the consequences. Have you noticed our government's response? In November 2025, the United States officially designated silver as a critical mineral, adding it to the same list as lithium, cobalt, and rare earths that are considered essential for national security and economic competitiveness. That designation sounds important until you realize it's mostly symbolic. We don't have significant domestic refining capacity. We don't have stockpiles large enough to buffer a supply disruption. We don't have alternative sources that can replace Chinese production in any reasonable time frame. The critical mineral designation is our government admitting we have a problem while offering no actual solution to fix it. Meanwhile, Russia and China are building the infrastructure to ensure silver and other strategic commodities flow east, regardless of what happens in Western markets. The Trans-Siberian Railway, that massive rail artery connecting Moscow to Vladivostok and ultimately to Chinese industrial centers, hit capacity constraints at 150.5 million tons back in 2023, according to Russian Railways data. The system was literally maxed out trying to handle the volume of commodities and manufactured goods moving between the two countries. So what did they do? They committed $2.7 trillion to infrastructure upgrades that will expand capacity to 255 million tons by 2032. We're talking about new rail lines, upgraded terminals, automated cargo handling systems, and expanded border crossings specifically designed to move resources from Russian extraction points to Chinese manufacturing hubs. This isn't some future possibility being discussed in planning meetings. This is active construction happening right now, and it's designed to create a commodity supply chain that completely bypasses Western markets and Western currencies. Here's an interesting detail that reveals the real priorities. While Russia and China are pouring billions into freight rail infrastructure, passenger rail service between the two countries has been suspended since 2020 and shows no signs of resuming. Think about that choice. They're not interested in tourism or cultural exchange. They're interested in moving copper, nickel, aluminum, timber, oil, gas, and yes, refined silver from Russian territory into Chinese industrial zones, where it gets transformed into solar panels, batteries, electronics, and electric vehicles that compete against our domestic industries. The math on this infrastructure investment is staggering when you run the numbers. $2.7 trillion over 10 years works out to $270 billion per year being spent to expand commodity flow capacity. That's more than most countries spend on their entire defense budgets. That's a level of investment that signals strategic priority at the highest levels of government. They're not building this infrastructure because it generates attractive financial returns. They're building it because controlling commodity flows from extraction to manufacturing is the foundation of economic power in the 21st century. Let's connect this back to your investment portfolio for a moment. If you own silver through exchange-traded funds like SLV or SIVR, you're holding shares that represent claims on metal stored in bank vaults, mostly in London and New York. Those vaults are part of the Western financial system that China is actively building around, and Russia is helping them bypass. When push comes to shove and industrial users need physical delivery, do you think the banks holding that metal are going to prioritize your ETF redemption or the semiconductor manufacturer offering to pay a $50 premium for immediate possession? The Bank for International Settlements released data last quarter showing that the total notional value of silver derivatives outstanding exceeds the total value of all silver that's ever been mined in human history. Read that sentence again. The paper claims on silver are larger than the entire above-ground supply of the actual metal. That works fine in normal markets where most contracts settle in cash, and only a tiny fraction demand physical delivery. But we're not in a normal market anymore. We're in a market where China just cut off the majority of refined supply, where India's single order froze the London market, and where COMEX inventories have been draining for 5 straight years. Every structural deficit year chips away at the available inventory buffer. Every paper contract that gets opened against diminishing physical supply increases the leverage in the system. Every industrial user scrambling to secure metal before their competitor does add stress to delivery mechanisms that were never designed to handle this kind of demand. And now China has weaponized their control over refining capacity at exactly the moment when our supply chains are most vulnerable and our inventories are at multi-year lows. You're watching financial engineering meet physical reality, and physical reality always wins that fight eventually. The only question is how much destruction happens to paper positions before the market acknowledges what physical buyers already know. The metal is disappearing into strong hands who aren't selling. Supply is constrained by geopolitical decisions rather than mining economics. And the price discovery mechanism is broken between futures markets quoting one number and physical markets demanding another. That gap is information, and smart money is paying attention to what it's telling them about the next phase of this crisis. Let's do the math that commodities analysts are running right now in spreadsheets they're not sharing on financial television. If China's export restrictions cut global refined silver supply by 50%, which is entirely plausible given they control 60 to 70% of refining capacity, the annual deficit explodes from 230 million ounces to over 5,000 metric tons. That's not a supply shortage that gets resolved with higher prices encouraging more mining. That's a structural break, where industrial users simply cannot obtain the material they need to maintain production regardless of what they're willing to pay. Here's why this becomes catastrophic rather than just expensive. 60% of industrial silver demand has no viable substitute, according to the Silver Institute's technical assessments. You cannot manufacture a semiconductor chip without silver-based conductive pastes that create the microscopic connections between transistors. You cannot build a solar panel that achieves acceptable efficiency without silver contacts on photovoltaic cells that conduct electricity generated by sunlight. You cannot produce an electric vehicle with the necessary electrical connections and battery components without silver alloys and compounds that handle high current loads without overheating. Walk into any semiconductor fabrication facility and ask the production engineers what happens if silver deliveries stop. They'll tell you the manufacturing line shuts down within days because there is no alternative material that provides silver's unique combination of electrical conductivity, thermal properties, and chemical stability at the microscopic scale required for chip production. The entire global electronics industry, everything from smartphones to data centers to military systems, depends on a steady supply of refined silver that China just put under export restrictions. The solar industry faces the same existential dependency. Engineers have spent decades trying to reduce or eliminate silver from photovoltaic cells because it's one of the most expensive components in panel manufacturing. Despite billions invested in research and development, the best alternative materials achieve only 70 to 80% of the efficiency that silver contacts provide. In an industry where every percentage point of efficiency matters for commercial viability, that performance gap means silver remains irreplaceable. Now, imagine you're a solar manufacturer with contracts to deliver panels for utility-scale projects, and your silver supplier just informed you that delivery timelines are uncertain and prices are doubling. You can't switch to less efficient alternatives without breaching your contracts. You can't pass the cost increases to customers who signed fixed-price agreements. You're trapped in a situation where your business model breaks if you can't secure silver at close to the price you planned for. What's the fair price for a metal that has no substitute in applications that define our economic future? Let's look at the gold-silver ratio, which compares how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio sits around 57 to 1, meaning you need 57 ounces of silver to equal the price of 1 ounce of gold. The historical mean over the past century is 15 to 1. If silver simply returns to its long-term average relationship with gold, we're looking at a 280% increase from current levels, pushing silver toward $200 per ounce, even if gold doesn't move higher. But here's what makes this moment different from previous silver rallies. The historical gold-silver ratio reflected monetary relationships when both metals served as currency and reserves for central banks. Today's ratio should reflect industrial utility, and silver's industrial applications are expanding faster than gold's at an accelerating pace. Every data center powering artificial intelligence uses silver in server components and cooling systems. Every solar installation fighting climate change uses silver in photovoltaic cells. Every electric vehicle replacing internal combustion engines uses silver in battery management systems, electric motors, and charging infrastructure. The demand curve is exponential while supply just became capped by geopolitical restrictions. That's not a recipe for returning to historical averages. That's a recipe for silver potentially outperforming gold by margins we haven't seen since the Industrial Revolution transformed silver from a monetary metal into an industrial necessity. Consider what happened during the last major silver shortage in 1979 and 1980. The Hunt brothers attempted to corner the silver market by accumulating physical metal and futures contracts. And the price spiked from $6 to $50 per ounce in less than a year. That shortage was artificial, created by speculative buying that could be resolved once regulators changed margin requirements and forced liquidation of leveraged positions. The shortage we're facing now is fundamentally different because it's driven by structural supply constraints and irreplaceable industrial demand. You can't regulate away China's export restrictions. You can't force liquidation of semiconductor manufacturers who need silver to produce chips. This shortage ends only when supply increases dramatically or demand collapses, and neither of those outcomes seems likely in the near term. Now let's talk about the timing of what's happening in January, because understanding these next few weeks is critical to positioning yourself correctly. The Chicago Mercantile Exchange raised margin requirements on silver futures in late December, forcing leveraged traders to either post more collateral or close positions. That triggered technical selling pressure that has nothing to do with supply and demand fundamentals. The price pullback from $84 to the $70 to $76 range created what technical analysts call a consolidation zone, a temporary equilibrium before the next major move. Right in the middle of this technical consolidation, Bloomberg is rebalancing its commodity index between January 8th and January 14th. Index funds that track this benchmark must automatically sell approximately $5 billion worth of silver futures to match the new weightings. That's massive selling pressure hitting the market during a one-week window, and it's entirely mechanical with no discretion involved. The fund managers aren't making a judgment about silver's fundamental value. They're following algorithm rules that require them to match the index composition regardless of market conditions. If you don't understand what's happening, you watch CNBC report that silver is falling and assume the rally is over. If you do understand, you recognize this as the last opportunity to acquire physical metal before the supply crisis reasserts itself and prices gap higher on delivery failures. Think about the setup from a risk-reward perspective. The downside is limited by the $70 support level where physical buyers in Asia are willing to absorb unlimited supply at that price or higher. The upside is unlimited because once delivery failures start occurring, there's no ceiling on what industrial users will pay to secure the metal they need to maintain production. You're looking at an asymmetric bet where the worst case scenario is a temporary 10% pullback during the rebalancing window, while the best case scenario is a doubling or tripling of prices as the paper market loses credibility and physical scarcity drives premiums to unprecedented levels. Commodity analysts, who actually study supply rather than just chart patterns, are projecting $90 to $120 per ounce by the second quarter of 2026 if COMEX faces delivery failures that force cash settlements. Cash settlement means the exchange tells you they can't deliver the physical silver you contracted for, so here's money instead based on the futures price. That works fine if you wanted speculative exposure to silver prices and never intended to take delivery. That doesn't work at all if you're a manufacturer who needs actual metal to keep your production line running. When cash settlements start happening, the paper market loses credibility and physical premiums explode because industrial users realize they can't rely on futures contracts to secure the material they need. We're already seeing this play out in Asia, where physical premiums have detached from COMEX quotes. If delivery failures accelerate, analysts estimate physical silver could command $150 to $200 per ounce in Asian spot markets, while COMEX futures still quote $70 or $80. At that point, the paper market becomes irrelevant for anyone who actually needs to use silver rather than just speculate on its price. The two-tier market becomes permanent, with paper contracts trading at fantasy prices, while physical metal trades in a separate market at much higher levels reflecting actual scarcity. Arbitrage between the two markets becomes impossible because you can't convert paper claims into physical metal when the custodians don't have inventory to deliver. Think about what this means if you hold silver through exchange-traded funds like SLV or SIVR. These funds own metal stored in allocated or unallocated accounts with custodian banks. The prospectus for every major silver ETF includes force majeure language that allows them to suspend redemptions or settle in cash rather than physical delivery if circumstances beyond their control prevent them from accessing the underlying metal. China, cutting off refined silver exports while COMEX inventories are at multi-year lows, would absolutely qualify as circumstances beyond their control. That fine print you ignored when you bought the ETF shares becomes the mechanism through which you get locked into paper settlement at suppressed prices while physical holders capture the real gains. Here's the scenario that keeps precious metals attorneys up at night, and it's playing out in slow motion right now. A rush of redemption requests hits silver ETFs as investors realize physical premiums are surging above the ETF price. The ETF manager contacts the custodian banks to deliver metal against the redemptions. The banks don't have adequate physical inventory because they've been lending the same bars to multiple parties under fractional reserve practices that are standard in bullion banking. They thought they could always recall the loaned metal on short notice because there was always supply available in the market. But now China has restricted exports. COMEX inventories are depleted, and the banks realize they can't actually deliver against all the claims outstanding. The ETF invokes force majeure and announces that due to unprecedented market conditions, they're suspending physical redemptions and will settle in cash based on the COMEX paper price, which is trading $50 to $100 below the actual physical market price. You thought you owned silver that would benefit from the supply crisis, but what you really owned was a claim on metal that doesn't exist, and you got paid out in dollars at the artificially suppressed paper price, while physical holders captured the real gains. The lawyers will spend years arguing about whether the force majeure was legitimate, but by the time the courts rule, the opportunity will be long gone. This isn't conspiracy theory speculation. This is reading the prospectus language that is already in your ETF documents combined with understanding the mechanics of how bullion banking works when physical supply becomes constrained. The system is designed to work smoothly when most contracts settle in cash and only a small fraction demand physical delivery. The system breaks when delivery demand exceeds available inventory, which is exactly where we're headed as China restricts exports and industrial users scramble to lock in supply. Every major financial crisis involves the same pattern where people discover too late that the thing they thought they owned was actually a claim on something that doesn't exist in the quantity everyone assumed. So what's the play here if you understand what's unfolding? The deadline is right now, during this January 8th to 14th Bloomberg rebalancing window, while technical selling pressure is creating temporary weakness in paper prices. Physical buyers, who comprehend the supply crisis, are using this dip to acquire metal outside the banking system before the two-tier market fully separates. They're buying coins, bars, and allocated storage where they have direct ownership of specific serial-numbered pieces rather than claims on fractional reserves. They're accepting premiums over spot price that seem expensive today, but will look cheap when physical metal is trading at $50 to $100 above paper quotes. The strategic question you need to answer is whether you want exposure to silver prices or ownership of actual silver. If China's restrictions persist, if COMEX inventories continue draining, if industrial demand keeps growing while refined supply shrinks, then the difference between paper claims and physical possession becomes the difference between getting paid at the suppressed futures price or benefiting from the physical premium that reflects actual scarcity. One of those outcomes is watching other people profit from a crisis you saw coming. The other is being positioned correctly when the system acknowledges that paper and physical are no longer the same thing. Let me be clear about what I'm not saying. I'm not predicting the end of financial markets or telling you to panic, sell everything, and buy silver. What I am telling you is that a major commodity with no industrial substitute just had its primary supply source weaponized by a geopolitical competitor, while inventories in Western markets are at multi-year lows and industrial demand is accelerating. That's not a typical cyclical commodity shortage that resolves itself with higher prices, encouraging more production. That's a structural shift in how strategic materials are controlled and distributed, and the implications extend far beyond silver prices. Our entire approach to commodity security is based on assumptions that no longer hold. We assumed global markets would remain open and accessible. We assumed competitive pricing would ensure supply availability. We assumed financial instruments were equivalent to physical ownership. Every one of those assumptions is being tested right now in the silver market, and the results should concern anyone who depends on strategic commodities for their business, their investments, or their understanding of how markets function. The math is straightforward when you strip away the financial complexity. Demand exceeds supply by growing margins. Existing stockpiles are depleting. The largest refining source is now restricted by export controls. Industrial applications are expanding faster than mining can increase production. The paper market quotes one price, while physical metal trades at massive premiums. All of those statements are factually true right now based on publicly available data from commodities exchanges, industry associations, and government reports. The question isn't whether this creates pressure on silver prices. The question is whether you'll be holding paper claims or physical metal when that pressure translates into delivery failures and the two-tier market becomes permanent. We're living through the early chapters of a supply crisis that will force our country to confront uncomfortable realities about strategic dependence, commodity security, and the difference between financial assets and physical resources. China recognized this decades ago and positioned themselves accordingly by building dominant refining capacity and using it as leverage. Russia is helping them build the infrastructure to move commodities east, regardless of Western market disruptions. We're still operating under the assumption that market prices and paper contracts will solve supply problems through normal price discovery mechanisms. That assumption works until it doesn't, and we're watching in real time as the silver market demonstrates what happens when geopolitical control over physical supply overrides traditional market mechanisms. This is your notification that the rules have changed, the game is different, and the players who understand that distinction will be positioned very differently than those who keep trusting that paper and physical are interchangeable. The next few months will reveal which assumption was correct, and by then it will be too late to adjust your position if you chose wrong. The January rebalancing window is closing, physical premiums are widening, delivery failures are starting. What you do with this information is up to you, but you can't say you weren't warned about what's coming. That export restriction is the smoking gun. That $55 spread between Tokyo and New York is the evidence. That $5 billion rebalancing between January 8th and 14th is the mechanism. And that China-Russia rail expansion is the reason you need to understand right now that the two-tier market isn't theoretical anymore. It's here, and the window to position yourself on the right side of this wealth transfer is measured in days, not months. End of broadcast.